Hey, everybody. Welcome to another episode of AML Conversations. My name is Joe McNamara. I am the Director of Solutions Marketing here at AML RightSource. And joining me today for an awesome conversation around blockchain hopping and some other interesting facets is Senior Director of our Financial Crimes Advisory Group, David Lutz. David, welcome, man. So glad to have you on the show.
Thanks, Joe. I appreciate it. Thanks for having me.
Yeah, absolutely. And for clarity for everybody else that's tuning in to listen to this, I just kind of want to give a quick synopsis in terms of what we're talking about today. So like I mentioned, blockchain hops, immediate indirect exposure, and really a lot of things that we're seeing kind of coming out of or continuing to come out of the digital cryptocurrency kind of blockchain industry. But, one of the things that kind of spurred this conversation for me was a recent post that you threw out on LinkedIn, essentially just kind of breaking down like some of the differences on how to look at these things. But rather than having a marketing guy talk about this to a bunch of, very well qualified practitioners, I figured I'd better turn it over to the professional. So David, from your perspective, when you talk about blockchain hops, can you give us a little bit more context around that?
Yeah. So what do we mean by blockchain hops? Like in the context, hops refers to basically the number of intermediary blockchain transactions or wallet addresses that separate known illicit or criminal activity from the wallet or entity that comes up in blockchain analytics tools. In other words, an alert. Okay. So, if you look at it from 0, 1, 2, 3, and so on, 0 hops, basically direct receipt of funds from a sanctioned or illicit wallet. 1 hop, funds pass through one wallet before it actually hits the subject wallet in the blockchain analytics tool. 2, funds pass through one or more wallets or transactions before it makes its way to the subject wallet, and so on. So that's really the definition, kind of how you would explain the hops
For
in
sure.
this context. Yeah,
For sure. And then, to kind of add some layers to this, obviously one of the things that we're talking about is, how many hops away should you be, or should an institution be kind of taking into consideration from a known sanctioned or illicit source to reasonably monitor or at least, kind of put some rules and parameters around, how to continue to service or in some cases kind of walk away from those accounts?
Yeah, that's a great question. It's a great starting point. There's no universally mandated hop count. But from what I've seen across the industry, many of the compliance teams typically monitor 2 or 3 hops from a known illicit source should it come up in their blockchain analytics tool. So why is that? Because beyond that, the risk becomes significantly diluted, and the ability for an investigator to definitively attribute risk exposure weakens as the hop counts increase. But it really, honestly, it depends on the context. If the exposure involves a high-risk jurisdiction or obfuscation patterns, meaning they're trying to deliberately hide the source of funds in the original transaction, you might have to go deeper. Ultimately, institutions need to build a policy that's consistent, risk-based, and defensible when examined by the regulators. So you might take, some recent hacks in preceding years. Ronin Bridge hack by the Lazarus Group in 2022. Funds moved quickly across wallets and through Tornado Cash. I think everybody's heard of Tornado Cash at this point. If your customer received ETH directly from a Tornado Cash output, just 1 or 2 hops from those hacked funds, that's definitely a high-risk alert, right?
Sure.
But if a customer receives Ethereum from Binance 3 hops later with no sign of, mixers or use of, or red flags in between that, the exposure is technically traceable, but the risk is diluted because we're not really able to ascertain whether those funds were really for illicit purposes. So
True. Right. And that, I think, when you kind of literally follow the trail, follow the money, that's normally where you end up. But, clearly direct transactions with sanctioned wallets represent probably the highest risk, I'm assuming, although would love to hear
Definitely.
kind of your thoughts on it. Um, but what about like those indirect links? And like you mentioned, some of those that are several hops away, like, is there any additional rule of thumb when it comes to, marking or kind of, defining your exposure as negligible in terms of, what you're going to be responsible for when a regulator comes to take a look at what you guys have been up to?
Right. I mean, direct exposure is straightforward. That's a red flag. If it's, from one wallet to a known or illicit wallet address or a sanctioned wallet address, that's when you want to, intercept, block, or reject the funds.
Sure.
But when we're talking about indirect exposure, a few steps removed from the known illicit wallet address, it gets a little bit murkier, right? So if the path between the parties is transparent, doesn't involve techniques like mixing or layering the transaction, in between it gets to the subject wallet, my particular customer, for example, that risk may be negligible. The core question is, was that exposure incidental, or is there evidence of deliberate structuring to conceal origin? So it's really about the intent. That intent makes a big difference in how we assess the risk,
For
right?
sure. For sure. And I think that actually that takes me down a path. So like you mentioned, in terms of, whether you can establish intent, obviously one of the main components of blockchain is its inherent immutability, right? And like, because of those kind of characteristics, does that mean that perpetual guilt is there by association? Essentially, like, if it's immutable, what kind of compliance decisions kind of come about, or at least discussions about decisions when working with this type of currency come about?
Definitely. I mean, that's a great question. The blockchain being immutable never forgets, but we have to, set a limit at some point. So, immutability means the data is always there, but risk relevance fades over time. Yeah, it fades over, including like the distance away from the original transaction. So, it's a double-edged sword. It's both a blessing and, blockchain is both a blessing and a curse. Yeah, the data lives forever, but that doesn't mean the risk should. So you have to, as an institution, you have to use judgment and apply a risk-based approach. If you're looking at a transaction that touched a tainted wallet address, a wallet 5 years ago, and there's been no suspicious activity since, that's a very different story than a transaction that passed through a mixer or darknet marketplace last week, right? So
Sure.
you have to really, consider the risk, assess the time, the behavior of the wallet address, and whether there's any current cause for concern, not just historical activity.
Sure. Right. And I think that kind of lines up with what we see in more of the traditional space, just around, how you build typologies. And I feel like, every institution kind of has its own flavor, as it should, right? Everybody has their own, risk appetite, or kind of what they're comfortable with. I guess my other question is for anybody who is potentially looking at getting into this space of being able to service, crypto and digital currencies. Are there, any other specific kind of rule of thumbs, or I guess rules of thumb, that they should be considering? Like, and again, what I'm thinking about more is, like you said, there's so much context that has to come with this style of banking, and certainly, how you're assessing, risk in this area. But, for anybody that's curious, what do you or your team normally kind of advise in terms of, best places to start, I guess?
Yeah, I think, you have to look at, if you're a banking institution, you have to look at really like your risk appetite, right? If you're looking to offer cryptocurrency directly, as would, a centralized exchange, or indirectly, meaning onboarding, digital asset businesses in the industry, be it an exchange, a token issuer, you really have to assess whether, you have the program in place to sustain compliance and ensure that you have the appropriate controls in place that, brings transparency to the blockchain ecosystem, be it your customers are transacting in crypto directly through your payment rails, or indirectly through a third party relationship. If you decide to onboard an exchange and offer cryptocurrency indirectly, right?
Mhm.
You have to make sure that you have the tools, the staffing in place, the expertise, because it is definitely it's a much different financial ecosystem than what we're typically accustomed to seeing in traditional finance.
For sure. And that brings up a good point too. When I think about the differences, and they're vast between DeFi and kind of CeFi, one of the overwhelming trends that I've seen, at least as an onlooker, and not necessarily on the front line, is this concept or kind of trend of these new age these new age companies that are kind of scooping up talent in terms of regulatory practitioners,
Sure.
folks that otherwise have probably spent the majority, if not all, of their career kind of in the traditional financial space. And I just find it interesting. It's probably more of a call out than like a direct question, but I do find it interesting that the tenants that kind of come from the traditional financial space are certainly making their way either directly or indirectly into the decentralized space.
Sure.
In your opinion, here's the question, I guess. In your opinion, from a regulatory perspective, are there any like other shifts or things that we're seeing in the space that we need to expect or might need to effectively, balance in terms of dealing with blockchain tracking, or in more generalized cases, just being able to offer, fair and practical, essentially services?
Yeah, I think, if you're a banking institution, you definitely have to look at, blockchain analytics tools. They operate much differently than, your traditional transaction monitoring system. The speed with which cryptocurrency moves is much faster and much, less transparent as far as who is the sender and receiver of those transactions than you would typically see, in a wire transfer, an ACH transaction. So you have to really weigh the pros and cons of onboarding these types of institutions and make sure that, you have the appropriate program in place to offer these products and services.
Absolutely. And that's probably a good jumping off point in terms of today's conversation. I would say, I'd be remiss if I didn't at least mention the recent write-up that you put together for us, kind of regarding this area, right? So
Sure.
there's a new white paper out, that's, whether it's a white paper or a business brief, whatever we're calling it. I thought it was super insightful. It's called Risk and Control Measures for Bank Crypto Engagement. Any final thoughts in terms of kind of what you were thinking about when you put this together? Who would this be for? And, obviously, what kind of folks should be interested in working with you and your team when it comes to, bank and crypto engagement?
Yeah, I think, I put that paper together because, we're receiving opportunities to work with banking institutions, large and small, who are interested in entering this space. I think when you look at kind of the regulatory climate, there's still some ambiguity around, regulation and legislation around cryptocurrency. But I think there's a lot of opportunity in this space as well to work with some cutting edge technology to help, provide additional banking services and products to individuals, be it or consumers and businesses. So, I think we're in that digital era where if you don't look at cryptocurrency or blockchain technology as, a lever to offering additional services to your customers, you might be the last in the next couple of years. But having said that, we need to see more regulatory guidance coming from the regulators. it's been somewhat, a gray area. I think a lot of banking institutions haven't really been entering this space too much or systemically because of the ambiguity around regulation and legislation, as well as you see, many lawsuits in previous years from the SEC against different cryptocurrency protocols, Tether, XRP. So that kind of makes, folks a little apprehensive to really dive right in. But I think, the way that blockchain and cryptocurrencies operate, it's transparent, it's immutable, doesn't bring perpetual guilt by association or anything like that. But, it offers a lot of opportunities, where I think, aligns well with sort of where we're seeing the industry is heading, third party relationships in fintech, banking as a service, things like that. So, but more to the paper that I drafted, you really have to weigh the risks when you're onboarding or getting into this space, and whether or not you have the tools and the risk appetite to offer it.
There you go. Heard it from the man's lips himself. So, David, just wanted to say thank you again, man. I'm sure this is the first in what I assume will be quite a few conversations to come in the future. But, just wanted to say thank you. And, for everybody else listening, thanks for tuning in. We look forward to, providing some additional insights. For anybody that's looking for more information on this, please go check out David's new paper. It's all over the AML RightSource website. As well as our larger resource center, too, that you can find on the AML RightSource website. All right, everybody. Thank you.
Thank you. Thanks, Joe.